Hi. So let's begin with understanding what is the financial fraud. Financial fraud is a deliberate misstatement or omission of amounts or disclosure of financial statements to deceive the financial statement users, particularly investment and creditors. Let us dissect this a little bit so that we can understand a definition a bit in a bit more detail. So deliberate. So the definition of fraud is deliberate misstatement. Now, the difference between deliberate misstatements and undeliberate misstatement means by mistake is that there's an intention of somebody to deliberately misstate the financial statements. So, what are the misstatements? We will be looking at those in our detailed examples later on, but let's give you just give you some example. Let's say the something costs you $10,000. Maybe you have made a sale or contract of $10,000, but you are recording at 50,000 just to increase the sales. That is, if you have done it by mistake, maybe you have read the contract wrongly, or you may have you didn't understand the real transaction, and the accountant by mistake recorded at 50,000. That will not be considered as a fraud, but provided that you are able to prove that there is sufficient check and balances, and the person who has done it has done it without any valified intention, means it is not deliberate, and that whenever the detection is find out, we have adjusted it. But the deliberate misstatement really means it that the person's motive is to increase the sales value, maybe to get the commission, to show the higher profitability, or whatever reason. So there is a so the fraud is linked to the intention of somebody who is doing it. So now you have deliberate misstatements or omissions of amount. So there may be you may be recording not you may be not recording an amount. Maybe you have litigation which you have lost, but you have not paid the amount yet, and you know it, but you are not recording it in your books of account because you wanna misstate it. You want to omit the amount for the time being, so that you can show a greater profitability in one year. So that is called omission. To misstatement means you have the amount, but you are showing it in a wrong manner, or maybe you are mixing between the revenue expense and the capital expense. Maybe you are doing overcharging the sales or whatever you are doing, but there is some transaction and you are not doing it properly. The second is omission. So you don't record the transaction at all. You don't want to show it into the financial statements. The third method of fraud is the disclosure of financial statements to deceive. So you may be clubbing the account payable and account receivable to show less account payable and no account, so to show less account receivable and no account payable to have a better current account ratio maybe. And you may also be doing this with loans. You may be putting the loan into the current liability to show a better debt equity ratio. So there are many methods how you can deceive the financial statements uh, to fool the investors and also the creditors. So we're going to be learning those in more details, how you can do that, and how we can, particularly most importantly, how do we detect it. As a disclaimer, the objective of this course is not to teach how to do the frauds, but how to detect the frauds and how to make the corrective action plans and ways to so that the errors and frauds are automatically detected. Please don't learn how to do the frauds because that is not something very good. You will learn what are the cost of frauds in the coming slides so that we can understand them in a better manner. So that is the definition of financial frauds. Just to summarize, a deliberate mistake, omission of amounts, or disclosure of financial statements, financial statements user, particularly investors and creditors.